June 19, 1934. A single document sat on the resolute desk of President Franklin D. Roosevelt. It wasn't a declaration of war. It wasn't a deployment order for the Navy. Yet this piece of paper, the Silver Purchase Act, possessed enough kinetic energy to dismantle the economy of a sovereign nation halfway across the globe. History books will tell you this legislation was designed to assist American miners during the Great Depression. That is the official narrative. But in the back rooms of the Treasury, the reality was far more brutal. By artificially tripling the global price of silver, Washington turned the metal into a financial weapon. The target was China, the only major economy still operating on a silver standard. The result was not assistance, it was an extraction. American banks, seeing a massive arbitrage opportunity, began draining China's silver reserves, shipping the metal across the Pacific to U.S. vaults. The Chinese economy entered a death spiral immediately. GDP collapsed by 25%. Banks in Shanghai failed in cascading waves. A stable monetary system that had lasted for centuries was obliterated by a signature in Washington. December 27, 2025. 91 years later, the ghost of that decision has returned. Silver just smashed through $75 an ounce, posting gains of over 150% this year alone. But do not mistake this for a standard bull market. The nation that was once victimized has learned the ultimate lesson. Currency is a weapon. Today, China is the world's largest consumer of silver and is systematically hoarding the metal, restricting exports and draining global supply. They are running the 1934 playbook in reverse. Only this time, the capital flight isn't happening in Shanghai, it is happening in the West, and the currency being targeted for destruction isn't the Chinese yuan, it is the United States dollar in your pocket. If you believe the current inflation is accidental, you are watching the wrong screen. This is a coordinated economic counterattack, and it has already begun. To understand the mechanics of this economic assault, we must first strip away the sanitized version of history taught in schools. The year was 1933. The United States was hemorrhaging. The stock market had collapsed, banks were vaporizing savings, and unemployment was tearing the social fabric apart. President Franklin D. Roosevelt was desperate. He needed a political win, and he was willing to break the global financial system to get it. Enter the Silver Bloc. This was a powerful coalition of senators from mining states like Nevada, Colorado, and Montana. They held Roosevelt's New Deal agenda hostage with a singular demand: artificially inflate the price of silver. Their argument was that higher silver prices would enrich American miners and stimulate the Western states. It was a bailout, plain and simple, a wealth transfer from the public to a specific industrial sector. In June 1934, FDR capitulated and signed the Silver Purchase Act. The mechanics of this law were designed to manipulate the market on a scale that would be illegal for any private entity. The act directed the U.S. Treasury to purchase massive quantities of silver until the metal constituted 1/3 of America's monetary base, or until the price hit $1.29 per ounce. Here is the critical detail. The global market price for silver at the time was roughly 45 cents. By setting a statutory price of $1.29, the U.S. government effectively tripled the value of silver overnight. On the surface, this looked like domestic policy. But in the interconnected world of finance, there is no such thing as a purely domestic action. The United States had long abandoned the silver standard, but across the Pacific, China had not. For hundreds of years, the Chinese economy operated on a silver-based currency. It was one of the most stable monetary systems on Earth. In fact, while the Western world was being crushed by the Great Depression, China had largely avoided the catastrophe precisely because they were shielded by silver rather than the gold standard. The Silver Purchase Act shattered that shield. When Washington artificially pumped the price of silver, they didn't just help Nevada miners, they created a massive, irresistible vacuum. They turned the U.S. Treasury into a black hole that began sucking the monetary lifeblood out of China. This was not an unforeseen accident. The historical record suggests a much darker reality. Henry Morgenthau Jr., FDR's Treasury Secretary, was fully aware of the devastation this policy would unleash. Diplomatic correspondence from the time reveals that the administration knew the stability of China was being menaced by the act. Chinese Finance Minister He Kung sent desperate pleas to Washington, explaining that the silver drain was causing severe deflation and dislocating China's balance of payments. The American response was cold bureaucratic indifference. The administration essentially replied that their hands were tied by Congress. They chose to sacrifice the economic stability of a nation of 500 million people to satisfy the political demands of a few mining magnates in the American West. This confirms a brutal truth about the global financial system. Monetary policy is simply the extension of war by other means. The U.S. government treated China not as an ally, but as collateral damage in a domestic political calculation. They knew the gun was loaded, they knew where it was pointed, and they pulled the trigger anyway. But the real devastation wasn't just in the price charts, it was on the streets of Shanghai, where American banks were waiting to capitalize on the chaos. The heist wasn't conducted with masks and guns. It was executed with balance sheets and shipping manifests. When the Silver Purchase Act went into effect, it created what financiers call an arbitrage opportunity. In reality, it was a predator's loophole. American banks operating in Shanghai, institutions like National City Bank, now Citibank, and Chase National Bank, the predecessor to J.P. Morgan Chase, saw the discrepancy immediately. Here was the math. An ounce of silver in Shanghai was trading at its natural market price. That same ounce, if transported to the United States Treasury, was worth 3 times as much. For the banking elite, this was risk-free profit. They began to aggressively buy up every silver coin, ingot, and artifact they could find in China to ship back to the U.S. The drain on China's reserves was not gradual, it was a hemorrhage. In 1932, China's net silver exports were a manageable $10 million. By 1934, after the act passed, that number exploded to $256 million. That is an increase of over 18 times in a single year. This massive capital flight triggered a catastrophic deflationary collapse. You need to understand what happens when the physical money supply of a nation simply vanishes. Credit dried up instantly. In Shanghai's financial district, interest rates skyrocketed from a stable 6% to a crushing 26% per year. This wasn't just a number on a screen, it was an eviction notice for the Chinese economy. Real estate values in Shanghai crashed by 15% as liquidity evaporated. Industrial stocks fell, and businesses failed in cascading waves because they could no longer access capital to operate. Farmers, the backbone of China, watched the prices of their crops collapse while their debts remained fixed in silver value. They were wiped out. The Chinese government saw the abyss opening up. H. Kung, the Minister of Finance, sent frantic cables to Washington. He didn't just ask, he pleaded. He explained that America's policy was dislocating China's entire balance of payments and pushing the nation toward anarchy. The response from the Roosevelt administration was a study in diplomatic gaslighting. They acknowledged the damage but claimed their hands were tied by the legislation. Essentially, we know we are destroying you, but domestic politics come first. Desperate to stop the bleeding, China imposed a heavy tax on silver exports in October 1934. But laws only apply to those who cannot afford to ignore them. The foreign banks operating in China held extraterritorial privileges, making them largely immune to Chinese law. And where legal immunity wasn't enough, brute force took over. Historical accounts detail how silver was smuggled out of the country not just by merchant ships, but with the assistance of U.S. and British warships. These military vessels could bypass Chinese customs inspections entirely. It was state-sponsored smuggling disguised as naval operations. The lesson here for the modern investor is stark. When the profit margin hits 300%, sovereignty becomes a nuisance and the law becomes a suggestion. The banks got their risk-free returns, the U.S. Treasury got its silver, and China was left with a hollowed-out shell of an economy. But the worst consequence wasn't the poverty. It was what the poverty created. The vacuum left by the silver drain was about to be filled by something far more volatile: paper money and political revolution. On November 4, 1935, the inevitable happened. Bled dry by the American silver vacuum, the Chinese government officially surrendered. They abandoned the silver standard that had anchored their economy for centuries. In its place, they instituted a new paper currency, the Fabi. The government nationalized all silver, ordering citizens to hand over their hard assets in exchange for these new paper notes. At the time, it was sold to the public as a modernization reform. In reality, it was the removal of the only brake pedal on a runaway train. For a brief moment, the bleeding stopped. But fiat currency has a fatal flaw. It requires discipline, and politicians in crisis have none. When the Second Sino-Japanese War broke out in 1937, followed by the brutal Civil War, the nationalist government no longer had to mine silver to pay for it. They simply had to run the printing press, and run it they did. What followed was one of the most horrific episodes of hyperinflation in recorded history. The government printed money until the numbers became meaningless. Inflation didn't just rise, it detonated, running at thousands of percent per year by 1948. The savings of the Chinese middle class, teachers, shopkeepers, civil servants, were vaporized. These were the very people who supported the nationalist government of Chiang Kai-shek. When their life savings could no longer buy a bag of rice, their loyalty evaporated. This connects directly to an uncomfortable truth that Western historians often overlook. Milton Friedman, perhaps the most influential economist of the 20th century, analyzed this period extensively. His conclusion was chilling. The American silver policy was a primary architect of the communist victory. Friedman argued that the hyperinflation destroyed the middle class and created the chaotic vacuum that allowed the current regime to seize power. The sequence is undeniable. The U.S. weaponized silver, China lost its monetary sovereignty, the economy collapsed, and the government fell. This is where the story shifts from history to modern strategy. The leaders who took power in Beijing after 1949 did not view this as merely bad economic luck. They viewed it as a lesson in national survival. They understood that a nation that relies on another country's currency or financial infrastructure is a nation on its knees. They learned that he who controls the hard assets controls the outcome. For decades, while the West grew comfortable with its fiat dominance, creating derivatives of derivatives, China never forgot the humiliation of the 1930s. They internalized the reality that paper money is a temporary illusion, while precious metals are permanent power. They swore that never again would they allow a foreign power to dictate the value of their labor or the stability of their borders through financial manipulation. But they didn't just vow to defend themselves. They began to plan a counteroffensive. For the last 20 years, quietly and methodically, they have been preparing to turn the table. They have been building a stockpile designed not just to withstand a dollar collapse, but to potentially engineer one. Fast forward to December 2025. The trap is sprung. We are currently living through the fifth consecutive year of a global silver supply deficit. But to understand the severity of this shortage, you must understand how the battlefield has changed since 1934. Back then, silver was merely money. Today, it is something far more critical. It is energy and technology. China has recognized a fatal difference in the modern economy. You cannot build the digital age without silver. It is the most conductive metal on the periodic table. It is the non-negotiable DNA of the green energy revolution. China now controls over 80% of the world's solar panel manufacturing. Every single panel requires silver paste. But it goes deeper. Silver is essential for 5G infrastructure, AI data center servers, and electric vehicles. More frighteningly for Washington, it is a strategic military asset. It is found in the guidance systems of Tomahawk missiles, in satellites, and in the control rods of nuclear reactors. In 1934, the U.S. drained China's money. In 2025, China is choking off America's industrial oxygen. Reports from late 2025 confirm that Beijing has implemented strict new licensing requirements for silver exports. They are hoarding the metal for domestic use. The data from the Shanghai Gold Exchange proves this. Silver is trading at a significant premium, nearly 10% above global spot prices. This premium is a signal of physical tightness. The metal is staying in China, and the inventories at the exchange have plummeted to multi-year lows. Contrast this with the United States. In the mid-20th century, the U.S. held the largest strategic stockpile of silver in history. Today, that stockpile is gone. The U.S. government sold off its strategic reserves decades ago, assuming the free market would always provide. We are now 100% dependent on just-in-time inventory and imports. If China turns off the tap, the U.S. tech and defense sectors don't just pay more, they stop. Many of you might be asking the classic capitalist question: if the price is $75, won't miners just dig more? This is the most dangerous misconception in the precious metals market. Supply is inelastic. Approximately 70% of all silver produced globally is a byproduct. It comes from mines that are primarily digging for copper, lead, or zinc. A copper miner does not care if silver hits $100. They only care about the price of copper. They will not ramp up operations for a secondary metal. Furthermore, primary silver mines take time. From discovery to pouring the first bar, the average lag time is now 5 to 8 years. Even if we started digging today, that supply wouldn't hit the market until the 2030s. We are facing a structural deficit. Demand is exponential due to AI and green energy, while supply is flatlining or declining. China has done the math. They know the West is walking into a resource wall, and they have positioned themselves to own the latter. The industrial chokehold is tight, and the US is discovering that you cannot print silver. But the final phase of this strategy isn't just about starving industry, it's about dethroning the king. While Western media obsesses over stock market indices, a new financial architecture is being poured in the East. The foundation was laid at the 2025 Moscow Financial Forum, where BRICS nations unveiled their ultimate weapon, a dedicated precious metals exchange designed to bypass New York and London entirely. This is not just a trading platform, it is a declaration of independence. Alongside this exchange, they are piloting the unit, a transactional currency anchored 40% in gold and 60% in a basket of BRICS currencies. The goal is explicit: to create a settlement mechanism where the US dollar is neither required nor welcome. Skeptics often argue that the dollar is too entrenched to fail. They are looking for a sudden explosion, but de-dollarization is not a heart attack. It is death by 1,000 cuts. The data is already bleeding out. As of late 2025, official reports indicate that 68% of trade among BRICS nations is now settled without using the US dollar. The dollar's share of global reserves has dropped to roughly 58%, its lowest level in 25 years. We are witnessing a historical symmetry that is almost poetic in its cruelty. In 1934, the Silver Purchase Act caused a massive flow of physical wealth from east to west. Silver left China and filled the vaults of the U.S. Treasury, funding the rise of the American century. In 2025, the direction of the flow has completely reversed. Physical gold and silver are now draining from Western vaults and moving east. Central banks globally have purchased over 1,000 tons of gold annually for the last 3 years, the longest sustained buying spree in modern history. BRICS nations are responsible for more than half of this accumulation. But here is the detail that should keep you awake at night. Much of this buying is unreported or anonymous. Western central banks and sovereign wealth funds are quietly participating in the frenzy. They are publicly projecting confidence in fiat currency while privately hedging against its collapse. They know something the average citizen does not. The debt is unpayable, and the only exit is a devaluation of the currency against hard assets. This brings us to the final verdict on the price action. Silver at $75 is not a bubble. It is not a meme stock rally. It is the market finally waking up to the reality of fiat currency depreciation. It is a repricing of real money in terms of fake money. China understands this game better than anyone. By securing the physical supply of silver, they have secured the choke point of the future economy. They control the inputs for the green transition, the digital infrastructure, and the military-industrial complex. They have successfully flipped the 1934 script. The US once used silver to break China's sovereignty. Now China is using silver to break the dollar's hegemony. The trap has been set, the metal has been cornered, and the West is just now realizing it is playing with a hand of unbacked paper. History does not repeat itself verbatim, but it certainly rhymes. In 1935, the citizens of Shanghai handed over their silver and placed their absolute faith in paper money. They believed the state would protect their wealth. Within a decade, they lost everything. Now, look at 2025. What are you placing your faith in? The outcome of this economic war has already been decided. It wasn't fought with aircraft carriers, but in the deep storage vaults of central banks. The United States fired a silver bullet at China in 1934 to cripple a rival. Today, that exact bullet is ricocheting back across the Pacific. Only this time, it travels with the velocity of the digital age and the weight of a desperate industrial shortage. Do not expect a rescue. The Federal Reserve cannot print more silver. The government cannot legislate geology. The system is currently preoccupied with its own survival, not yours. Take a hard look at your portfolio. Look at your wallet. If your entire life's work is stored in paper notes featuring dead presidents, you are volunteering to be the collateral damage of the next chapter. In the end, all paper returns to its intrinsic value. 0. Watch the silver.